The moment you answer that one question at a car dealership, you've already lost thousands of dollars. You do not even realize it happened. You walk out thinking you got a decent deal. The salesman walks back in and closes his day feeling great, and somewhere between those two feelings is the money that used to be yours. This video is going to show you exactly how that happens and the 5 steps that flip the entire game in your favor before you ever walk through a dealership door. Here is the question that costs people thousands every single time. How much per month are you looking to spend? It sounds harmless. It sounds like they are trying to help you. But the moment you answer, the moment you say 500, 600, whatever your number is, you have handed them the wheel. Here is why. A car deal has multiple moving parts. The price of the car, the loan term, the interest rate, the add-ons. Every single one of those variables can be shifted around independently. And when you give a salesperson your monthly budget, they do not use it to find you the best deal. They use it as a ceiling, and they work backwards from there to extract as much as possible while keeping your payment just inside that number. Here is what that looks like in practice. Say you are looking at a car with an MSRP of $27,000. At a 6.5% interest rate over 5 years with nothing down, your monthly payment comes to around $528. You told them your budget is $500 to $600 a month, so you are already under your ceiling at the listed price. A salesperson who knows their job will never tell you that. Instead, they will steer you toward a higher trim. They will add a dealer package, tinted windows, floor mats, a protection coating you did not ask for. They will find ways to push your payment up towards 600 because that is the number you gave them permission to reach. And then comes the 4-square worksheet. This is a document some dealerships use with 4 boxes: trade-in value, vehicle price, down payment, and monthly payment. It looks simple, clean, transparent. But watch what happens during negotiation. Numbers get crossed out. New numbers replace them. Loan terms stretch from 36 months to 60 months to 72 months. Your monthly payment drops. Not because the price dropped, but because you are now paying for longer. By the end of it, the vehicle price has barely moved, but the sheet looks like you won something. You did not win something. You just agreed to pay interest for an extra 2 years. And here's the part that makes this worse. By the time that worksheet is in front of you, you have already been sitting in that dealership for 3 hours. You are tired. You want to drive the car home. You are not doing math anymore. You are just looking for a reason to say yes. That is not an accident. That is the design. But the monthly payment trick is only half the problem. Because there is a second way dealerships make money that most buyers never see coming, and it is built directly into your interest rate. When you apply for financing through a dealership, they submit your application to a lender who comes back with a rate you actually qualify for. Then, the dealership is legally allowed to mark that rate up and keep the difference. This is documented. In 2015, the Department of Justice settled with Honda specifically over dealer interest rate markups, and the settlement language made clear how standard the practice was across the industry. Honda agreed to cap dealer markup at 1.25% for loans under 60 months. 1.25% sounds small. On a $27,000 loan, that 1% markup costs over $700 extra in interest. Some dealers mark up by 2%, some by 2.5%. On a larger loan that is thousands of dollars paid for a rate you never knew was inflated, and you would never know unless you walked in already knowing what rate you qualified for. 5 steps. 30 minutes of preparation before you set foot in any dealership. That is the entire difference between a buyer who gets taken and a buyer who takes control. Step 1. Know your real number before anyone asks for it. Not a range, not a feeling, an exact number. Use the 24-10 rule. Put at least 20% down. Finance for no more than 4 years. Keep your total monthly car costs payment plus insurance under 10% of your gross monthly income. If you earn $84,000 a year, your gross monthly income is $7,000. Your total car costs should stay under $700 a month. If the car does not fit that math on a 4 or 5 year loan, it is too much car for where you are financially right now. Know that number before anyone asks. Step 2. Get pre-approved before you arrive. Go to your bank, your credit union, or an online lender and apply for pre-approval on the loan amount you need. They will tell you exactly what rate you qualify for. Now, when the finance manager comes back with a rate that is 1.5 points higher, you already know. You have leverage, you have a competing offer, and you signal immediately that you are not someone who can be worked with a vague number and a handshake. Pre-approval also cuts hours off your time at the dealership because the financing conversation becomes a comparison instead of a negotiation from scratch. Step 3. Never answer the monthly payment question. When the salesperson asks what monthly budget you are working with, your answer is, I am not focused on the monthly payment. I care about the total price of the car. That one sentence changes the entire dynamic. It tells them you understand how the game works. It forces the negotiation onto the only number that actually matters. And if they apply pressure urgency tactics, today only deals slow everything down deliberately. Tell them you need time to think. Tell them you're not buying today. The car will still be there tomorrow, and negotiating over email after you leave is always an option. Step 4. Keep your loan to 60 months maximum. The average new car loan in 2026 is between 69 and 72 months. Every month beyond 60 is more interest paid and more time spent underwater, meaning you owe more on the car than it is actually worth. If the car gets totaled or you need to sell it before the loan is paid off, you are covering that difference out of pocket. 60 months is the ceiling. 4 years is better. Hold that line. Step 5. Say no to almost everything in the finance office. After the price is agreed, you will be walked to a finance manager's office. This is the second sales pitch. Extended warranties, paint protection, fabric coating, wheel insurance, gap coverage. All of it gets presented as essential. All of it gets rolled into the loan, and all of it compounds the interest you are already paying. Say no to almost all of it. The one exception worth considering is gap insurance, the coverage that pays the difference if your car is totaled and you owe more than it is worth. But even then, do not buy it from the dealership. Call your insurance provider after you leave and add it there for a fraction of the cost. Everything else, extended warranties, protection packages, can wait. You can always buy them later without the pressure of a salesperson watching you sign. So here is what this comes down to. Dealerships are not evil. They are businesses built around specific tactics. The monthly payment focus, the interest rate markup, the add-on room, the fatigue of a long visit. Those tactics work because most buyers walk in without knowing they exist. You now know they exist. 30 minutes of preparation, your real number, a pre-approval letter, and 3 simple rules for what to say and what to sign, and none of those tactics work on you anymore. The buyers who get the best deals are not better negotiators. They are just more prepared than the person in the chair next to them. So before you walk into your next dealership, or before someone you know does, ask yourself this. If you sat down with a finance manager today, would you know the difference between the rate you actually qualified for and the rate they decided to charge you? Because that gap, invisible to most people, is exactly where thousands of dollars quietly disappear.